Good evening, everyone. This is Rajendran here, joining from Market Calls, and welcome everyone to webinar on Ultimate Guide to Momentum Trading. Now, in this session, we're going to learn many things about momentum trading strategies, the basics of momentum trading strategies, and what you should understand while doing a momentum trading strategies, how to implement a systematic momentum trading strategies, and even we're going to discuss about uh, different types of momentum trading strategies like cross-sectional momentum trading strategies, ranking. That is what we're going to look in this particular session. So we're also going to look into 3 different momentum trading strategies. So before getting into the session, just give me a quick confirmation about the audio and video quality. As usual, the session is getting recorded, and as usual, the session will be posted back to you. In YouTube channel, will be available by end of the day. So there is a Q&A box is there. You can always post your comments over there. All right, great. So most likely what we're going to discuss is that kind of a mathematical momentum trading or kind of a momentum investing, like how to do momentum investing. What are the various types of momentum investing is what we are looking to this in this particular session. A little bit about me. My name is Rajendran. I'm the founder of Market Calls and also co-founder of Algo Mojo. I've been trading in this market since 2006 onwards. My focus shifted towards systematic trend following back in 2009, and of late, after 2012-13 onwards, I also shifted my focus towards market profile and order flow. So first of all, if you ask me what is momentum trading, momentum trading is like just simply following the price, nothing much. Nothing much to do basically there, because we'll be simply buying the breakouts. We buy high and sell higher. And in order to protect the profits or in order to protect the losses, right? So in order to protect either the losses or in order to control the risk reward ratio, we will be applying trailing stop loss, or sometimes we'll be moving our stop loss closer to the break even or even towards the break even. We'll identify the trend strength. If the trend strength is fading away, we will exit the position. And it is simple, nothing much to complicate there. First of all, before looking into the momentum trading, right, we need to know how traders profit from the momentum trading. In order to know that, we need to understand how the price action moves in the markets. In order to understand this, right, so momentum trading, you need to understand what is diffusion innovation model. It is a model which is proposed by Rogers. He also got a Nobel Prize for bringing this model, because this model, right, it is applied to every industry, including trading and investing also. What Rogers says is that in any field, hardly 2.5% of them are innovators. When it comes to the markets, right, they are the one who is coming and buying at the bottoms, exact market bottoms, and exact market tops. Hardly 2.5%. Majority of the people are not going to come and buy exactly at the market bottom or sell exactly at the market top. Next comes the early adopters. They are the one who builds the very initial stages of the trend before the breakouts. They are the one who is coming and buying before the breakouts. And that is also 13.5% only. Now comes the early majority. Early majority is not interested in buying at the bottoms. They are not interested in buying at the early stage of the trend. They want some sort of trend to develop and then they want to tag along with the trend. And that is 34% of the community. Now, next comes late majority. Late majority is like once the trend is substantially developed, they come and join in the middle of the trend. They want a sure shot confirmation that the trend is going up, and they want to come and onboard on that trend. So they belong to the late majority. That is also 34% of the population. In any kind of in any kind of industry it is. But when it comes to trading, a good breakout happened, and after the good breakout happened and the breakout is still continuing, then only they will come and trade. That is what late majority is all about. And then laggards. Laggards are the one who comes and buy exactly at the market top and come and sell exactly at the market bottom. Now, if you are a trend follower, if you are coming and buying the breakout, then probably you are part of this early majority. You are part of what? Early majority, and you are trying to profit from the late majority and the laggard. So these are the two players. Early majority is trying to profit from them because the early majority they onboard, and then late majority they come and drive later on. After the once the late majority entered, finally the laggards enter, and finally the trend ends. And so these are the two population who are primarily responsible for the profits of early majority. All right. So basically, who is early majority? The one who follows the momentum or follows the trend. Basically, more or less, both are same only. Who follows the momentum? If you ask me, does the momentum trading works? But let me tell you how this diffusion innovation model is first connected with Nifty, right? So let me pull up a Nifty chart here. What I want to do is I'm going to bring Nifty spot data first of all. Let me bring Nifty spot data here. I'm going to Amibroker. Probably. Just give me a second. Yeah. And let me go to the index EOD data. And here, from here, let me pull up the NSE chart. So here is the Nifty chart on the daily time frame. Oops, here it is. Let me put up a plain vanilla charts here. So I'll go to the basic charts and pull up price in Amibroker. So we'll start something like with the monthly time frame, all right? In this monthly time frame, assume that somebody is an investor who invested some decade back around 2008. Maybe we can call them like an innovator. Hardly, not many people are interested in investing at those points. So whoever came and investing in these locations, very few people invested in these time because subprime crisis was going on. This is the time what is happening. Subprime crisis is going on. Subprime. Worldwide stock markets are tanking. There was a deep crash was there. Even institutional investors are fearing to take a position there. But however, very few people entered. Probably they belong to what? 2.5% of the community. We can say like that, like 2.5% of the community. They mostly belongs to the innovators. Hardly today, right? Nobody can recognize who bought at 2008 bottom. I bet it is definitely not institutional investors. Right? Institutional investors, they might be bought here and there, but definitely they are not the majority. Majority of the people who bought 2.5%, those 2.5% of the people, nobody knows and nobody remembers also. Obviously, trend follower will not come and buy here. And then comes the early majority. Next, the trend is getting developed. The trend is getting developed. And here, 13% of the people of the overall investing population would have been investing here. And they belong to the early adopters of the trend. The trend is getting just built in. And they are able to recognize that, and early majority early adopter is coming and buying here. And now one more breakout is happening. This is where the breakout traders come and enter. They are able to see that breakout is happening, probably 2008 breakout. The previous all-time high is happening. Previous all-time high has been broken. And now this is where the breakout traders, they will be looking for a confirmation. I'm just giving an example on the trend. So this is where the real breakout traders, they come and trade because price is breaking a multi-year high. So this is where we are seeing here. We are seeing a multi-year high is getting broken out. When the multi-year high is broken out, what is happening here is that new class of traders are coming and emerging. So that is where the early majority is coming and buying. Probably this is where the 2014 election started and price started breaking up. More people, that massive amount of people entered into the markets because we can say there is a new change is happening fundamentally or politically also. A new change is happening. So many people started investing over there. Then comes again one more set of breakout trader. So they are seeing one more all-time high, and that all-time high has been broken out. Here comes so this belongs to how many percentage? This belongs to 34%. 34% of the population. Now there is one more breakout is happening. Here, this is where the late majority is coming and entering over here. They are very late to the trend, but still that's fine. Late majority that's what they do. They want to check whether this is working or not. Yes, the breakout is working, so they are coming and buying over here. And they also belong to the 34% of the population. So this early majority, whoever entered over here, right, they need this late majority for them to be profitable. And of course, now probably think about that. One more breakout is happening. Maybe a breakout which is happening over here. A breakout, it's happening over here. And breakout is happening over here. Every place is what happens. The late majority will be keep on entering here. Late majority will be keep on entering at various locations. And of course, what is their percentage? Approximately 16%. So 16% of the people are coming and buying over here. 16%. Maybe we can call this a 16%. So these are the guys who comes at the end of the trend. Basically, that is not an impressive way to come and buy it. I can keep on doing this on any trend. So if you want to be in the early majority, let me tell you, being an innovator is going to be a really, really tough game. Mentally, a very, very tough game. An early adopter, it is also, it's not tough, but you need a lot of skills over there. Early majority, it is very simple because you are just going and chasing the price. You see the price, chase the price and follow the price, nothing much. However, you have to ensure that you are part of the early breakout. After seeing the breakout, coming and trading in the breakout, God bless you. Now, why I'm saying this is that the people who are coming after the early majority, right? They are the one who is going to contribute to your profits. So always buying when there is a bubble is not going to help you out. One, you have to enter previously when the bubble is already getting built up. Now let me tell you with one more interesting stuff here on momentum trading. There is a concept called systematic trend following, where it is nothing but a rule-based trading, which appeared in late 1960s. Typically, it was quite popular in US markets and quite become more and more popular in 1980s. The early 1980s, probably that is a time rule-based trading coming into the picture. And if you understand, mostly after 1995, most of the systems got computer-based trading started. And it is quite famous among the commodity trading advisors. in US, there is a particular set of group called CTAs, right? Like PMS managers in India, they PMS guys, what they will do, they come and invest in funds, or probably they will be investing in equities, most only long only guys. The CTAs, they are again funds, but they play in managed futures. They trade in F&O accounts. They trade in futures, they trade in options, they trade in OTA forward contracts. So they are also professional investment managers, similar to the PMS. The only thing is that PMS is for mutual funds. I mean, for mutual funds, it is PMS managers. And for trading in futures, it is CTAs. And of course, in India, we don't have CTA concept. We have only PMS and the mutual fund concept. This is quite popular among them, the commodity trading advisors. They are the first one to take the systematic trend following to the masses, like a fund. And since then, the systematic trend following has been quite popular worldwide. One interesting thing about the systematic trend following is that it brings discipline in your trading. Not only that, it also provides a strong risk management analysis. It doesn't look into any other external factors. It doesn't look into whether the US market is crashing or not. It doesn't look into whether the crude oil is correlated with our markets or not. What will happen if crude oil drops to zero or negative? Or what will happen tomorrow if there is going to be any negative news is going to come at the market open. It doesn't look into any fundamentals basically. What it follows is that it simply chase the price. It chase the price till it ends. Now, there are various ways to identify momentum. When it comes to identifying momentum, we can use indicators. Which are the indicators we can use momentum? Can anybody comment on that? You can just use the Q&A section to comment over here. There's a Q&A box over there. There you can go and comment on. Of course, ADX, RSI, right? So probably whenever you think about momentum, definitely you cannot ignore ADX and RSI. In fact, I'm also going to show you a very simple strategy about ADX and RSI. Of course, moving averages. Of course, moving averages chases what? It chases the price. Till it ends, the moving averages chases the price. MACD, of course. Stochastics, money flow index, ADX, that is what people are commenting. And of course, a lot of indicators are there. Not only indicators, you can also identify using candlestick breakout patterns. Right? So that is also one way of chasing the breakouts, right? What are the breakout setups you understand? Anyways, I'm not going to talk about candlestick breakout patterns, but probably I guess you would have studied numerous candlestick breakout patterns. What are the patterns you would have seen that? A triangle breakout, or probably head and shoulder breakouts. All these are nothing but what? Where we are trying to identify momentum using various techniques. Or probably Elliott wave, again, kind of an pattern where you can identify wave 3 or wave 5. Wave 3 is what? So even in Elliott wave, you can apply this. You can apply what? You can apply the simple concept of innovator, early adopter, early majority, late majority, or laggards. Let me tell you how. Probably wave 1 is what this is. Wave 1. Who are they? Wave 1, wave 1, wave 2, wave 3, and wave 4 and wave 5. Right. So this is 3 and probably 4 and 5. So wave 1, whoever is buying here, probably they belong to the class of innovators. Wave 1. Wave 2, in this slide, whoever buying here, they are mostly early adopters. They understand that the trend is getting developed. Early innovators already onboarded. So early adopters are coming and joining in this. They're coming and buying the dips. Early majority, they are the one who is the coming and buying the breakouts. They are the one who comes and buy the breakouts. They are part of the trend 3. And then finally, late majority, they are also coming and buying the dips here. They already see that the trend is there and they are coming and buying the dips, or probably even they're coming and buying here, they're coming and buying here. And then finally, laggards, they are the one who chases the final momentum. So they are the one who chase the final momentum. So without this guy, the 4 and 5, I mean, obviously, it is not going to work out. And of course, Iliad Wave is a better example to compare with the fusion innovation model. Anyways, we'll come back to the topic here. Anyways, today's topic is not about Iliad Wave, by the way. So what momentum trading is all about is, it is not about predicting the trend. It is just about seeing the breakout and following the trend, and of course managing the risk. Nothing much complicated. There is absolutely zero prediction here. You see the breakout and you buy the breakout. But at the same time, you also manage the risk. Oops, somehow it got closed out. Just give me a second. I think it's getting restarted over there. I'm sorry. So there are two different types of momentum we can witness here. One is time series momentum. Time series momentum is what majority of the traders they practice. That is what the indicator based trading, or you play strategies on one particular symbol, you apply the strategy and then you trade the strategy. It is all about, you see the price, how faster the price is breaking out, we go and see how good the trend strength is, and then we also go and chase the trend. Whereas cross-sectional momentum, probably this is what most of the fund managers, they would like it. Maybe you would have seen small case kind of platforms, right? So where they'll be having a portfolio of stocks. Probably the fund manager behind, probably an advisor or a fund manager behind that portfolio, he'll be working on ranking the stock. So cross-sectional momentum is all about ranking relative performance. They will rank out of 50 stocks, they will rank, and then they will buy top 5 stocks. Even out of 50 stocks, they will rank top 5 stocks and top worst stocks. So they will be selecting the best stocks. They will declare that these 5 stocks are the winner and they will buy the winner. Or they will declare 5 stocks as the losing stocks and they will even sell the stocks also. They can even go and short the stocks. So using cross-sectional momentum, you can build portfolio of trading strategies. By basically what is involved over here is that ranking is involved over here. In portfolio here, in cross-sectional momentum, what is involved? What is involved here is that ranking is involved here. Ranking is involved here. Number one, ranking will be involved. It also involves relative performance. Relative performance. For example, let's say a banking sector. Inside the banking sector, who is performing? I will rank all the stocks in banking and I will check based upon the volatility conditions. Probably ICICI Bank is doing good. Or probably HDFC Bank is doing good. So let me go and buy ICICI Bank and HDFC Bank. Compared to the other banks, probably these are the leading banks which are outperforming the market. So here in relative performance, we'll be looking whether it's an outperforming or underperforming. And we will be going and buying the winners. The third case is like not only ranking, not only relative performance. It also involves something called probably rotational trading. Rotational trading, or probably we can say like rebalancing. Let's not go detail into that. Maybe we'll look into this in another different chapter. This is a different style of momentum trading where they will be looking into portfolio of symbols, and then they will be mostly the ranking is the key over here. How do you rank the stocks, and what is your entry and exit condition? It is all about. Whereas time series momentum is what majority of the traders they play. Probably let's say like something like Nifty future. I'm buying a Nifty future. They'll be having an entry condition. They'll be having an exit condition. And obviously they will be having a trailing stop loss. They'll be having a trailing stop loss. or hard stop loss, and of course they will also having a profit booking levels also. So profit targets. Now this is how a time series momentum works. This relies on an absolute momentum. This doesn't look into the relative momentum. In relative momentum, what we will do? We will rank the other momentum also. What if Nifty is moving up, Bank Nifty is also moving up? Who is moving faster? We will compare between two different instruments or multiple instruments, and then we'll rank. Here there is no ranking thing. Instead, we will be doing what? We'll be measuring the absolute momentum, like using the tools like RSI, MACD, or let's say the ADX kind of tools. We'll be using these tools to do what? We will measure the relative strength of the market. I mean, we'll be measuring the strength of the trend, and here we will be measuring the absolute momentum. That is the two difference between time series momentum and cross-sectional momentum. If you ask me which is good, so that is more of a choice. How you want to trade yourself. Will you want to diversify? Obviously, you can look for a cross-sectional momentum. Cross-sectional momentum is a different kind of breed of momentum traders. Whereas time series momentum traders are mostly traders who come and simply they come and trade the breakouts, but they will be doing it on one single scripts. They don't care about they don't care about ranking stocks and buying the winners. Here, whether it is winners or losers, they don't care about in time series momentum. Whereas in cross-sectional momentum, they care about buy the winners. That is a simple concept which differentiates between the time series momentum and cross-sectional momentum. So in cross-sectional momentum, always buy the winners and sell the losers. And that's a very simple concept which has happened over here, which is there. And of course, we can also bring all these methodologies to along with ranking, we can also combine the entry mechanism, exit mechanism, trailing stop loss mechanism, hard stop loss mechanism, profit target mechanism, everything we can bring it inside the cross-sectional momentum also. But still we will be buying the winners and we'll be selling the losers. Whereas here, there is no such condition. Buy on entry condition and sell on exit condition. That is a simple thing which will be followed here. And no ranking. Now, let me tell you something interesting about time series versus cross-sectional momentum. Already we had seen this. The time series is only focused on whether a specific market. We focus on only specific set of market. Let's say I'm trading Nifty futures or buying Nifty futures. I will be applying my trading strategies. I'll be applying my trading rules. Whether when the market moves up, I'll go long. When the market goes down, I will try to short the markets. While cross-sectional work will rank markets, we'll be ranking the markets to buy the best momentum markets and sell the worst. So here is a simple time series momentum example. We are having a buy rule, when to buy, using a simple crossover condition, when to buy. So crossover of ADX, 20. I'm looking for a positive crossover of ADX crossing the 20 levels. And probably RSI should be less than 75. And the PDI and MDI means plus DI and minus DI, positive DI and minus DI. I'm just checking the positive DI should be greater than minus DI. And also I'm just having one more condition, filtering condition, like the absolute value of PDI minus MDI should be greater than 10. So that I want to buy that stock. I think like probably the strength in the market is increasing. And of course I will sell if the minus DI is crossing the positive DI. I want to sell it. Or if the ADX is crossing 50, maybe it's kind of an overheated scenario. In case of overheated scenario, ADX goes above 50, it will be generally considered as an overheated scenario. Or if the PDI minus MDI, the difference between PDI and MDI, if it is dropping down below a certain value, I mean, if it is going beyond a certain value, that is greater than 35, then in that case also I'm gonna exit my longs. So there are two things you need to know about it. One is going long, another one is exiting longs. And similarly, going short is what we call as a short. Exiting shorts is what we call as a cover. So these are terminologies on Amibroker. So let's say if I'm applying this strategy and I'm going to follow this strategy like a rule, like a soldier, how efficient the strategy it is. Is this strategy is profitable or not? So that is where Amibroker comes into the play. The tools like Amibroker comes into the play, where what you can do is that you can convert these rules into codes, and then we can simply do what? We can simply backtest this strategy. Let's say I'm just going to backtest this on a hourly trading strategy. Let me show you. I'm going to move to the last 8 years of database. I'm maintaining an 8 years of database. 10 years of database, of course, right from 2011 to 2020. So here is the last 10 years of database. And here, what I'm going to do here is I'm going to click and go to the new analysis. The tool what I'm using is Amibroker. So Amibroker 6.38 is what I'm using, the latest edition. Here I'm going to pull up that particular strategy here. So let me go to the systems, simple ADX trading strategy. You could see that it contains a couple of things. So first of all, it talks about how much you're going to how much to buy or sell. So how much quantity you're going to invest in that particular trading strategy. Let's say I'm going to invest only one lot of Nifty futures. I'm going to invest how much? Invest. Whenever the buy rule is going to match, I'm going to buy one lot of Nifty. Whenever the sell rule is matching, I'm going to close that one lot. Whenever short condition is happening, I'm going to invest only one lot of Nifty futures. And I'm going to short one lot of Nifty future. And whenever the exit short condition is happening, I'm going to cover that one lot of futures. Invest just only one lot every time. So a simple rule talks about how much to buy. And then it also talks about this is where the actual trading logic is all about. This is what we call as what? Trading logic. In this trading logic, we talk about when to invest. When to invest or trade. When to invest or trade. Basically, if you are writing a trading strategy, we can call this a trading strategy, or probably if you are applying it on daily time frame or weekly or monthly or quarterly time frame, we can call that as an investing strategy. Most of the cases, the cross-sectional momentum. So the cross-sectional momentum we talked about, right? The cross-sectional momentum. These cross-sectional momentum trading strategies are mostly investing strategies. This is also momentum strategies, but it is applied at an investing level mostly. And these time series strategies are applied at lower time frame level, or even at a higher time frame also we can go and apply it. So let's say here the simple strategy, I'm framing this buy rule, sell rule, short rule, cover rule. That's a trading logic. Followed by the trading logic, we also have a execution logic. Execution logic. The execution logic talks about what price to enter or exit. So let's say I'm just defining like at the close of the candle. So here I'm saying like whenever the buy condition is meeting, whenever my buy condition is turning true, I want to enter at the closing price of that particular candle. That particular candle, when the buy signal is happening, I will wait for the close of the candle, and at the close of the price, I will enter. And also it also talks about trading delay. Do you want to give a delay? Means, let's say sometimes, right, if you are an investor, you cannot buy exactly at the close of the candle. Maybe next day open, you can go and buy it. Next day opening price or near to the opening price, you can go and buy it. So that kind of delay you can give. How much delay you want to give for buying, how much delay you want to give for selling, and how much delay you want to give for shorting and covering, how much delay you want to give. If it is 0 means 0, 0, 0, 0 means that means no delay is given. No delay is given. Very simple, and it is in Amibroker, right? It is very easy to understand the coding language. Not only in Amibroker, similar to that, TradingView is also very easy to understand. You don't need to be a programmer to understand these things. And of course, if you are a programmer, it helps you. But even if you are not a programmer also, you can still understand 85% of the content if you are using if you are using TradingView or Amibroker kind of stuff. You don't need to be a hardcore Java programmer or Python programmer or something like that. So with this, you can create your own trading logic. Even to some extent, even a slightly complex logic also, you can go and build it. Now, the best part here is that we can also go back and apply this strategy, and we can do an automated backtesting. And in best case, you can also automate the trades also. You can automatically send these orders to the broker as well. Now let's see, there is a small send to analysis button is there. I send it to the analysis automatically. It opens a new window. It opens a new window here automatically. That particular code will be applied over here. And I'm going to say there is a settings over here. In this settings, I'm going to go and say like, apply this particular strategy on a hourly time frame. Now, the best part is that once you've done the code, you can apply it on any time frame. You can apply it on a 15-minute. You can go and back check how it is performing on a hourly time frame. And you'll say like, hey, I want to invest 2 lakhs of my money. So I'm going to play only 1 lot. I'm going to say like 2 lakhs of my money. I'm going to play both long and short. And I'm also going to say like my commissions. My commission is like 0.02% commission. So you can key in your commission over here. So let me tell you what are the settings you need to do over here. Couple of settings you need to aware about that. So one is you should make this periodicity, what period you want to backtest, which time frame you want to play this strategy, how much capital you're going to bring initially, what kind of strategy. Do you want to play only long or both long and short? If you are trading long, mostly if it's an investing strategy, of course you have to select only long only. So here, since you are a trader, we are applying both long and short. There are strategies you can design only to short only the markets also. And of course, the commission percentage, this is a must. We cannot ignore it because this is a major part of the trading strategy. Costs are involved, definitely. You buy or sell automatically. You have to pay to the broker, you have to pay to the exchange, you have to pay to the government, CB charges, turnover charges, transaction charges, STT will be there, GST will be there, whatnot, right? So all the charges the trader has to bear. So there'll be of course, trading is a business, so it involves a lot of cost. You have to pay to the broker, government, SEBI, and whatnot to various peoples. Now, let me press OK here. And once I'm done with that, I'll go and select the dates, from and to dates. I'll select the start date, from what date to what date you want to do the backtesting. I'll say like last 10 years, I want to go on backtest. I want to backtest in the current. I'll select current. When I say current, automatically, the Nifty is what automatically, which are the symbol which is there in the top. Not this tab, but it is from the topmost symbol tab. It will be backtested on the Nifty symbol. So a click of a button, what will happen? Amibroker will give the complete analysis and it will be giving the complete result. In a click of a button, you'll be end up getting the complete report in front of you. I don't know why it's taking a bit of time. Anyways, that's weird. Usually the results will be coming in a click of a button. Probably I think my Amibroker is a bit hanged, I guess. Let me check. I don't think it will be taking this much amount of time. Anyways, I'll do one thing. I'll close my Amibroker and then restart it. That's not a big deal. So let me close the program here. I'll relaunch. So I'll go to the last 10 years of database. That's a pure intraday database here. Database is a bit bulky, but still Amibroker is quite capable to do such kind of analysis. So I'll do the same thing, simple ADX strategy. Go and do the settings here. Make the periodicities as hourly, and percentage is 0.02, and the initial equity is 2 lakhs and long and short. So all these 4 settings are done. press OK, make sure that it is current and click on the backtest. Obviously the results will be in front of you. So immediately it gives you the results just like that with a click of a button for the last 20 years, last 10 years. It doesn't matter, even if you are having hundreds of years of data also, with the click of a button, the results will be there. In the next minute, it will be there on your screen. So all you have to do is that you have to build a trading strategy and then check it out whether it is working or not with that particular asset class. Now there is also a complete report here. If you click on the report, automatically it gives you the overall summary of this particular strategy. How good the strategy is all about. Is it a good strategy or a bad strategy? It gives you a lot of metrics. By studying these metrics, you can be able to calibrate whether the strategy is good or bad, or what kind of returns I can expect. What is the absolute returns it had made in the last 10 years? What is the win rate of the strategy? How many trades happened? Out of that, how many trades are winning trades? How many are losing trades? On the winning trades, how much profit it had made? On the losing trades, how many loss it had made? What is the average profit, right? Average profit per trade. What is the average loss per trade? So you can see that average profit trade is more compared to the average loss per trade, and hence the strategy is profitable. It is not because of the win rate, because most of the momentum trading strategy will be having a win rate anywhere between 30 to 55% generally. And it doesn't matter, even a 30% win rate strategy also makes money. Because of this, average profit is more compared to the average losses. All right, so that is the primary reason, right? The expectancy of the strategy is positive, and strategy makes money here. Not only that, it also gives a lot of metrics which says how good the strategy is. Is it a smooth returning? You're able to generate smooth returns in this particular strategy or not? And there's also another way to verify it. If you go to the charts, it tells you how your money is growing over a period of time. How your money is growing over a period of time. So you started with 2 lakhs and you keep on playing this buy, sell, buy, sell, buy, sell, buy, sell. So how your money is growing over a period of time, that is what we call it as a portfolio equity, or it is also called as equity curve. It's also called as what? It's also called as equity curve. So equity curve talks about what? How your money is growing, or at least whether it is growing or not. That is what it explains here. How your money is growing over a period of time after start following the strategy, after following the trading system. That's what an equity curve talks about. It talks about what? Equity curve talks about returns. Then there comes the second part. It talks about risk. This underwater equity, it's also called as drawdown. It talks about risk. How much risk is involved in this trading system? So you can see that at some point of time, the strategy started losing money. So here the strategy is losing money. It's been losing money for more than a year. And that in that case, it lost almost 16% of the total capital. From the peak, almost it had lost 16%. So 16% loss was there. Oops. 16% minus 16% loss was there. And then finally the recovery started. And then price also getting into profitable mode, and finally get into the profitable mode. This drawdown period, right? That's again, many people hate drawdown periods, but drawdowns are inevitable when it comes to any kind of trading strategies. You can mitigate it, but you cannot avoid it. Totally, you cannot avoid it. And again, the strategy is again going for one more drawdown period. You can see that there is one more bigger drawdown happened, and then it recovered back. Again, it went to one more drawdown and recovered back. Recently, there was a recovery happened after this because of this momentum started happening during the month of February, March. So recovery happened, but drawdown, right? From this phase, the drawdown was quite huge, almost some 9 months of drawdown here, probably some 9 to 12 months of drawdown here, 9 to 12 months of drawdown. And that is a phase that makes the trading quite challenging for the traders. Because traders, right, many traders in the markets, they want week on week returns, consistent week on week returns, consistent month on month returns. So of course, if you are an trend follower, if you're trading momentum, right, you're just simply chasing the price. So obviously you cannot anticipate consistent month on month returns or week on week returns. No matter how much ever intelligent your strategy is, or no matter how much ever simple your trading strategy is, or no matter how much ever complex your strategy is, at any point of time, any kind of trading strategy will go for a drawdown. Not only strategies, there are many times, even mutual fund managers, they go for a drawdown period. If you are trading systematically, it doesn't matter. Even if you are trading discretely also, you will go for a drawdown period. Even if you are an institutional manager, fund manager, you will go through a period of drawdown. Even if you are a Warren Buffett, you go through a phase of drawdown. Even if you are a Rakesh Jhunjhunwala, I guess he would have went through a period of drawdown. There are best phase, there is a worst phase. So as per the systematic trend following strategies, it doesn't matter how much you are making money on the winning side. What it matters is that how much, when you are in a drawdown period, how much you're going to lose it. That really matters. Again, obviously, once the worst phase is over, again the best phase starts. That is there with almost with every momentum trading system. Every momentum trading system, I mean, not only every momentum trading system, every trader will go through this best phase, and also they will go through this worst phase. And it is a cycle. It keeps on happening again and again and again. Even for Warren Buffett, even for Rakesh Jhunjhunwala also. So the worst phase is quite challenging, difficult to adapt. Many people will give up here. This is the phase. This is a phase. Many traders, what they will do is that they will change their strategies. They will change strategies, or they will change parameters. They will change parameters. This is where they will think like, oh my God, my strategy is not working, so let me change the strategies. Or they will add more filters, parameters. Or probably this is where many traders, they will lose belief. They will lose their belief, and they move on to the next system. Or probably they will be trading the strategy as long as it is working. The moment it is not giving money for 1 or 2 months and 3 months, they will start shifting to different strategies, or they will be jumping from one indicator to another indicator, because they will be looking for a holy grail. Let me tell you one thing. Momentum trading strategies are not holy grail, because absolutely no prediction is involved over here. What we are trying to do here is that we are trying to ride the trend as long as the trend is getting there. Why people do that? Because there is a thing called fat tails. How many of you heard the term fat tails? Any idea what a fat tail is all about? The fat tail is one of the primary reason you should do the trend following. Let me show you a very simple example here for an example for a fat tail. Very recently happened in Nifty in one of my strategy. I mean, it used to happen once in a while. Not a frequent thing, but an infrequent thing here. Let me pull up Nifty. So this is a very recent chart of one of the trend following strategy again. It's called quick flip. Quick flip, right? So here, let me go to the 5-minute time frame strategy. This is a 5-minute strategy, a very simple 5-minute time frame strategy. So here, what happens here is that sometime back, there was one of the strategy. It was going for almost this on a 5-minute time frame. It is still a positional trading system. So it's been on a downtrend. It kept on going down and down and down and down. Almost it went down for almost 500 plus points on the downside. It flipped and it kept on going up and up and up and up and up and up. Almost at some point of time, it even reached a profit of 955 points. And finally, it ended at ended roughly around some 847 points of profits. Now, this is what we call as a fat tail returns. This doesn't occur frequently in the markets, very, very rare. Probably it repeats every 6 months once, or every 1 year once, or every decade once. A steep 500 point profits on the downside, followed by a frequent 900 points profit. But the thing is that it doesn't occur on a monthly basis. Nobody knows where it's going to happen. But it happens. If you're following a system, right, it happens. This is what it contributes to these kind of fat tails. Is what making your lower win rate, even if you're having a lower win rate, because of this fat tails, is what makes momentum trading interesting. If you're going to miss this signals, right, then there is no point of doing the momentum trading at all. You know why? Because it is very, very tough to predict this kind of price action movement. Nobody can predict this kind of price action is just going to happen in the future. 500 points here on the downside, and another some 850 points on the upside, like 1350 points in Nifty in a span of 1 month, right? 1 month duration or less than 1 month duration. Nobody can imagine predicting these kind of movements. But still, in markets, once in a while, it happens. These kind of price action. Something like Bank Nifty, right? So there are times it had went to 3,000 points in Bank Nifty or 4,000 points in Bank Nifty. Once in a while, that kind of price action also happens in Bank Nifty as well. Bank Nifty or even in stocks. Nobody can imagine how far it can move. Sometime back, similar price action was there. It was happening when there was a corporate tax cut announcement was there. Sudden move happened, and then there was a 600, 700 point move happened in one single trade. Now, this is very, very rare. That is what it's called as a fat tails. I'm not going to go in details of what is a fat tail is all about. It is a statistical term. But in today's case, I'm not going to go in detail about that. If you are very much interested, you can go and check out about what a fat tail is all about. So it talks about a kind of a distribution, right? So that distribution is like, it talks about distribution. Basically, a fat tails lives here, fat tails. If you take returns, right, most of the returns falls under this normal distribution pattern. So this is kind of a skewed distribution which covers under extraordinary returns, which goes beyond 3 standard deviation. Such kind of returns, extraordinary, super extraordinary returns happens once in a while. If you are following the trend and you are disciplined to follow the trend, then only you can capture such kind of things. Other times what happens, basically markets will go sideways for majority of the time. Majority of the time market goes sideways. So you'll be getting a lot of small profits or small losses is what you're going to get. But this is the place where gigantic profits happens over here. And let me tell you, if you are going to play discreetly also, even if you would have played discreetly, I would doubt that even let's say 100 people are playing this game. Even if 100 people are seeing this game, what will happen, I'll tell you. Even let's say 100 people in a room, 100 people are there. And everyone is seeing this buy signal. People will buy here. Probably I think like some people will doubt. So they will not buy it. Let's say 20% of the time, 20% of the people, they don't participate. 20% ignore it. And 80% of the people would have been followed it. 80% they think like maybe this is a breakout and this is going to work out, and they would have bought that. They bought. Now out of this 80%, right? Some people might get greedy over here. They might get greedy over here. And they will think like, oh my God, the markets are given in a very short span of time, there was a stellar returns, almost 228 points. I'm going to exit my position. And that kind of community, right, definitely that crosses more than 70% of the people. 70% of the people, they will think this is going to be a super return. In a very short span, I made some good money. Let me say goodbye. Many traders, they exit their positions very, very early. And some people, right, they think, okay, let me follow my strategy. Signal is saying still buy, let me be in the buy. The remainder 20% of the people, they will think like probably they will try to participate, but still the moment they started seeing somewhere in the middle here, they will give up because it's getting more and more juicy returns. it's going like a more and more juicy returns at this point of time, right? Probably they will think like 500 points. So let me exit. 500 points is a decent profit. No, automatically the human minds will be thinking like that. That is the place you will stop following your own rules. The moment you started doing that, you're going to lose your discipline. That is what it's going to happen. And that will be done by 20% of the trader. Even it will be done by many experienced traders as well. The people know that they should not do that. Despite that, people do that. That belongs to the 20% of the community. And so the 70% of them, they will give up early. They will give up early and they will book early profits. So they will book early profits. And then 20% of the time, they will be riding the trend, but still they will give up. They'll be riding the trend. They want to follow the rules. These guys are they already seen that this kind of things happens in the markets. They will ride the trend. Because this kind of trend, right, will be happening when nobody want to believe this trend. Nobody want to believe entire economy will be against the markets. But still the trend will be keep on going on and on and on. Nobody knows why it is going. Very difficult. I doubt whether an economist can go and predict this kind of trend or not. Such kind of madness, nobody can predict because it is driven by madness. And very few people, 10% of the time, 10% of the people who will ride the trend. Probably they are disciplined and they are very systematic in a place. And that is going to be a very lower set of population. Maybe we can say like 5% or 10% of the population is what they are going to follow the rules. They know that the fat tail is there in the markets. No matter what, we have to follow the rules. You know what? System is simple, but it is not that simple to follow the rules. Especially when the profits are growing and growing and growing, you will get greedy at some point of time and you will be emotional. And then at some point of time, you will be taking the profits out. The same thing happens when the price is moving down or you are in a drawdown period, extensive drawdown period. It will shake the confidence of your belief on the trading system. So either way, even if it is, there are two things over here. People give up early, that has to be avoided, or people, they don't want to wait for the drawdown to come back. So when the money is growing, when the equity curve is going up, they are pretty much happy. They will be chasing the trend and they are pretty much happy about the strategy. But when the strategy is making a drawdown, right, people are not comfortable with the drawdowns. They will see like, oh my God, it's painful. Yeah, it is painful, but if you're a systematic follower, right, you have to follow this. This is where many people give up. This is where many people switch their indicators. And then once the drawdown period indicates, you'll be like relieved. And then maybe this drawdown period, right, at times it will be going for 3 months or even 6 months also sometimes. So you have to check yourself. How many of you are willing to go through a drawdown phase of 3 months or 6 months? At times, yes, you have to be. Or the worst thing is that they will be following all the rules. Every place they would have been following the rules. All these places, this signal, that signal, this signal, that signal, everywhere they will be following the rules. The moment they started seeing that big trends, they will cut it down early. You should not do that, because if you're going to do that, then there is no point of trading a trend following system. There's no point of following the momentum. So what is the point of following a momentum? Only to capture the trend, right? If you're not willing to capture it, then what is the point of following the trend? What is the point of following the trading strategy? You should ask yourself before jumping into momentum trading strategy, how you are going to trade your strategy. Or the best part you have to ask is, are you following your own trading strategy? If not, probably something you have to work out on your own inner self, and you have to come back and probably you have to get better on that. Most of the problem is not with the strategy. Most of the problem is with following the strategy, because it is not easy. It is simple. Strategy is simple, but following the strategy is not going to be an easier one. Especially we are surrounded with bunch of information, tons of information surrounding us, tons of economic information which will be thrown to us. And the way the price is moving, at times it will be shaken our confidence. Suddenly, let's say something like the coronavirus thing which happened, probably it would have shaken many investors' confidence. the one which happened. Let me go to that index EOD data, the monthly. So when this big drop happened, it would have shaken the entire world. The majority of the world in the investors' confidence would have been shaken. And that is there. That is a part of the job of momentum trading. But still, are you willing to follow the trading strategy? That is a real question you have to ask yourself. And if you're not doing that, maybe momentum investing is not for you. Momentum trading is also not for you. If you're not able to follow a simple strategy, probably you cannot follow any strategies. Forget indicators. Obviously, the search will be keep on going on for Holy Grail, and the search keeps on going on and on and on and on. But even in that case, right, even if you're having a 75% win rate, let's say you're having a strategy which is having a 75% win rate. Assume that is a strategy, 75% win rate. Obviously, it is possible because there are a lot of option selling algorithms. If you make, it will be, you can bring it 75% also. Even 90% win rate strategy is also possible. But that strategy is right. The equity curve will be more or less like this. You will be making money for 3 to 4 years. One fine day, there will be a sudden drawdown will be there. And again, it will be keep on going like this. And then again, a drawdown. There you will get your confidence will get shaken. And of course, if you take the September month and October month, majority of the option writer strategies are going for a toss because of that volatility in the markets are going crazy. Suddenly, if you see the market to this time reactions, right, you would have been very much surprised. What is happening here is that the market has been keep on going up every day. Market keeps on going up. I mean, last September and October month strategies, like this market has been keep on going up. In October, majority of the month you would have seen that. And suddenly the market crashes. And then market again start going up. Again, suddenly market is crashing. Again going up. Again, suddenly crashing. The crash is happening all in a sudden. It is crashing. And again, still markets are going up. But still overall, what we are seeing, the markets. This is how the market move has been done. And that had shaken the confidence of most of the option writers, because most of the option writers are bulls. By nature, they are designed to be bulls, and that's how they made most of their money. And but last September and October series, right? The September series and October series, really it is killing the patience of the option writers. If market is going to keep on doing this for another 3 months, people will start forgetting option selling and probably they will move to even something different strategies. Because they don't want to follow their own trading strategies. At some point of time, market will do that. Obviously, it would have done to many of the traders. In majority of the cases, it had done to me also. There are phases, I had gone through a phase of 3 months of drawdown and 6 months of drawdown, but still it takes solid confidence to believe in your own rules and to follow your own rules. And yeah, if you're not going to follow your own rules, if you're not going to believe in your own trading system, obviously you will be running in circles, like repeatedly. You take an indicator, test the indicator works good, you will be going around, indicator goes for a drawdown, you change the indicator or indicator parameters, and the cycle keeps on going on and on and on. That is not the right way to deal with the markets. Right? Somewhere it has to go away. You should need a proper mechanism or a testing solution. How I can bring more confidence in my indicator? How I can trust my own indicator? What are the ways? Probably there are a lot of ways to trust your own indicators. One is by doing a automated backtesting, not a manual backtesting. Many traders, they do manual backtesting. Manual backtesting is more prone to errors. Rather, the best way is to go for a automated backtesting. The tools like Amibroker or NinjaTrader, there are various tools are available in the markets, right? So, backtesting tools, it's backtesting. And that too, the fun part is that majority of the traders, right? Again, many traders, they make the mistake. The majority of 70% of the traders, I believe 70% of the traders, they don't collect the data. Rather, they will be backtesting on 6-month data. They'll think backtesting on 6 month should be more than enough. Or some people, they will think 2 years or 3 years of data is more than enough. And that's a wrong idea. That's a wrong idea. I can say that that's a wrong idea. When you're backtesting, you need to backtest on different market conditions. So probably that is what 30% of the people they will do. They will try to backtest on different market conditions, So let's say somebody is backtesting their long strategy only on the last 6 months, right? Obviously, it's going to work. But will it work on this downtrending markets? Not necessarily, because the market is different. Here the market is different. Here the markets are completely different. Here it would have worked. Here it would have worked. Here it would have worked. But how about these phases? Imagine this phase is this is a low volatility phase. Imagine this phase is high volatility phase, high volatility, higher fluctuations in the markets. So obviously you need to cover at least a bull market cycle, bear market cycle, low volatility, high volatility, strong trend, slow trend, sideways markets. Everything has to be covered. So for that, at least you need something like at least more than 5 years of data. Now, how many of you backtested more than 5 years of data? If you would have backtested more than 5 years of data, you just simply type yes. Very few of them, right? Very few of them would have backtested on 5 years of data. Probably that's still not a true picture of the markets. That is still not a true picture of your trading strategy. Probably you will get a fair idea about how much risk you have to take. It gives you a total idea about, at least it will give you an idea whether strategy is working or not. And also gives a true picture about risk profile, how much I should bet in this particular trading system. It will give you that kind of idea. And of course, on top of that, you can do optimization. And there are a couple of methodologies you can practice, like optimizing to enhance your performance of your trading system, optimization. And followed by that, you can do walk forward testing, walk forward. Generally, walk forward is an testing procedure to check whether your strategy will work on unknown data or what. So, or whether your strategy is curve fitted or not. Many strategies are curve fitted in the markets, curve fitted, right? So, like it's very easy to curve fit the data using Amibroker kind of tools. You can build and super duper results in the back test, but in reality, it doesn't. It shows something completely different. And then number 4 is like Monte Carlo. So Monte Carlo is again validation technique, which will tell in terms of probability, right? It talks in terms of probability of winning, because it takes large amount of data sets. Probably like it does random simulations on 1,000 times of simulations or 1 lakh times of simulation, and then it will check. It will tell you like even if the data points are changing, how your system will behave. Kind of an stress testing. We can call that as a kind of a stress testing. And almost Monte Carlo is done in every engineering field, right from finance to automobiles to aeronautics. Everywhere it is done to do a stress testing. It is kind of a Monte Carlo is a kind of a strategy testing to do a stress testing on the trading systems. So it will give you 1,000 probabilities, 1,000 possibilities. If out of that 1,000 probabilities, let's say 70% of the time the strategy is on the winning side, or 70% of the time out of 1,000 trades, 700 times your strategy is winning. And that gives you more confidence. So we will be using Monte Carlo to gather more confidence. And walk forward testing to ensure that strategy is not curve fitted. Yes, different market conditions, it is working separately. That is kind of the testing procedures. These are mostly testing procedures, statistical testing procedures. And there are also a lot of tests there. T-test statistic is there. So there are various ways to test whether the strategy is robust or not. All right. So ideally, these 4 things, the backtesting, optimization, walk forwarding, and Monte Carlo, all these are essential part of momentum trading. For a statistical validation, it gives you a scientific based validation technique saying that, yeah, the strategy is looking good, and yes, you can go and trust the data. Even if your strategy is going for 1 or 2 months of drawdown, or even 3-4 months of drawdown also, still you can have faith in your trading system, and still you can continue the worst phase. When the best phase is bouncing back up, you can go back and still continue your trades over here. That is what the validation system helps you. If the system itself not validating through the walk forward or Monte Carlo, we simply stop trading that system. I mean, simply we'll stop designing that trading system, or we'll be trying to think differently. Maybe we have to come up with different empirical techniques to validate our trading rules. Now let me also look into, so the drawback, what is the major drawback of that momentum trading? There are only major two drawbacks are there. Many people are not comfortable with the win rate. Typically the win rate will be anywhere between 35 to 55%, depends upon whichever the time frame you are using. If you are using higher time frame, generally win rates will be slightly higher. It goes to 55% to 65, 70%. If it's on something like daily, weekly, quarterly kind of time frame. But higher the time frame, lower the frequency of the trades. So probably if I go and apply on a daily time frame, right? Let's say one of the strategy, let me go and apply here on a daily time frame. The number of signals frequency is going to be very, very less. Let's say here I'm going to apply one of the strategy here. This year hardly 1, 2, 3, 4, 5, 6, 7 trades would have been happened. And so for 7, waiting for the trades, right, it's going to be a painful one, because if in case we are only an investor, hardly you had only 3 trades over here. 1 trade over here, immediately you got an exit. Second trade, it ran through the sky. And the third trade, it was a very small trade from an investing standpoint. And of course, if you ask me, does it predict anything? Absolutely zero prediction here, because just only rules are applied. When rules are just only applied here, rules doesn't predict the markets. Rules only helps you to exit early from the trend. When the trend itself changing, it helps you to exit from the trend, because the rules are nothing but what? A bunch of mathematical rules. So do you think these kind of mathematical rules, though it is making money, does it predict anything? Absolutely not, because they are nothing but simple mathematical formulas. Simple mathematical formula is not a crystal ball. It is more of a tool. You can use it to control the risk and to ride the winners. You can reduce the risk and you can improve your winning trades. And then there are times you will be going through the extended drawdown period. Nobody knows how much extended it is, but generally 3 to 4 months is what maximum one can tolerate. Anything more than 6 months, it will be like a headache. And anything it's going for more than 6 months, like you will start doubting your own trading systems. At least a trading system which is having an drawdown, probably it should be somewhere between an acceptable drawdown. What is an acceptable drawdown to you? Accordingly, you have to start thinking about designing such kind of trading strategies. So ranking, as I said, so this is a simple ranking. I had picked up the weekly RSI, and I picked up top 10 stocks, top 10 heavyweight stocks. And from that, I just ranked that weekly RSI. So whatever you are seeing on the momentum column is nothing but a weekly RSI, ranked it. So whichever is having the top momentum, we will be going and buying it. So let's say TCS and Infi is showing top momentum, we just simply go and buy it. I mean, this is not a buy or sell recommendation, but I'm just giving an example here. We'll be ranking that stock and we'll be buying that top stocks. That is how the ranking mechanism works. Probably if you would have seen small case, right, various such kind of strategies are probably there. Like it's very quite common that thematic investing websites these days. And it's not something new. It's there in the right from the CTA days. It is there. It's been there for 30, 40 years, and it's nothing new. But it is new for most of the traders, because this is you're creating your own ETF there. You're creating your own ETF based upon ranking. What will be keep on changing is that the symbol list will be keep on changing. Maybe the fund manager might be watching 500 symbols. 500 symbols, let's say out of this 500 symbols, out of CNX 500, like let's say maybe it's not CNX 500, by the way, we can call that as a Nifty 500. Oops. Yeah. Out of this Nifty 500 pack, Nifty 500 pack, maybe they might be having a portfolio of 10 symbols or 15 symbols. Every month or every week, the 10 or 15 symbols will be keep on changing. So you'll be closing your old position and you'll be adding new positions. So when the ranking every 1 month, right? Every 1 month or every 1 week, re-ranking will happen. ranking will happen. So when the re-ranking is happening, what they will do, they will close down the old stocks and they will initiate new, they will bring down new stocks, because every week the ranking will be keep on changing. So they will be always buying what? They will be always buying the winners. Always buy the winners. Or you can also short the losers also. Short the losers. Or you can also create a neutral approach. You can also create a neutral strategy, market neutral strategy. Always you will be having a portfolio of, let's say, 7 stocks you will be always having on the buy side. And let's say like 3 stocks you're always having on the sell side. So that wise your strategy will be diversified. And you can also create a neutral approach to the market. Maybe 7 buy, 3 sell, or 5 buy. Always you'll be maintaining a 5 buy position. Always you'll be maintaining a 5 sell position. So irrespective of the market direction, you will try to make money, because you will be buy the winners, will be mostly winners, and you'll be trying to sell the losers. So irrespective of whether the market is crashing or whether the market is going up, you can also build a neutral trading approach towards trading also. That is a very fun part in momentum trading. Momentum trading, right? Using momentum trading is not only directional. You can also build a neutral approach also. Anyways, let me move on to the next part. I mean, maybe if we will be talking extensively about ranking, right? We thought of discussing from an investing perspective how you can create your own small case, right? So that is what we will be discussing in our one of our event. Like, so it's the event name is Quantzilla. So it is an 75 hours of coding program in Amibroker. We can go and check out our past videos over here as well. So where it's more about systematic trading, creating your own indicators, or probably creating your own ETF ranking, how to do a strategy backtesting, how to create your own alerts, dashboards, strategy development, strategy optimization, or strategy evaluation, or creating your own long short trading strategies, or creating your own intraday trading strategies, or how to do option backtesting, and how to do pair trading, right? Something like the quant stuff like statistical arbitrage, how to use these kind of statistical arbitrage concepts, how you can bring it into Amibroker. That is what we're going to discuss over here. Now, of course, this time we're going to extensively talk about this ranking. And the best part is that there is also one more advanced course over there included with this Quantzilla advanced course. This is mostly related to the trade management, position management, and risk management, mostly related to order slicing, right? So trade adjustments and hedging, all these are related to automated process, how you can automate your trades, and how you can build different execution modules. The Quantzilla Advanced is more related to the traders who are mostly involved with automated trading, or who want to build various execution strategies like multi-leg execution strategies or arbitrage strategies, kind of more advanced strategies, or scalping the spreads. So those kind of advanced things will be discussed in the Quantzilla Advanced. So totally it is a 75 hours of program, and we are starting on November 21st. We have been starting up. So you can go and download the brochure and you can check out the complete agenda and what is there over here. You'll be able to get to know the complete details. Complete agenda will be over here. Now let's move on to the one of my favorite trading systems. This is a Wheelintra V5 trading system on a 15-minute time frame in Nifty futures. Let me tell you a little bit about this strategy. The strategy is mostly an adaptive momentum trading strategy, slightly advanced strategy. Means, for example, let's say when you're trading an EMA crossover, right? Let's say an EMA, simple EMA strategy. The EMA, let's say you're using a 10 EMA. The 10 EMA always remains like a 10 EMA. But what if, let's say next 3 days it will be 10 EMA, and later on it shifts itself to 20 EMA, and then when it is coming down, let's say it's becoming like 50 EMA, and it is like 75 EMA. Like it keeps on changing, depends upon the different market condition, how it is. Something like that is what Wheelintra V5 trading strategy is all about. So it uses an multi-time frame approach to the trading. So it classifies the volatility into 4 categories. One is high volatility, another one is like low volatility, extreme high volatility, and extreme low volatility. So different market conditions. This is summer. Assume that this is a summer condition, and probably winter, and probably this is like autumn, and this is like spring. Right? So like different seasons, right? We also classify market into different volatility seasons. Different volatility seasons will be using different parameters. Maybe I'll be using 100 over here and 120 over here, maybe 150 over here, and probably 200 over here. This is the different parameters I'll be using on different conditions. So automatically the adjustment will be happening, depends upon the various conditions which are happening in the markets. So adaptive parameters for different volatility conditions. And it is also more of a multi-time frame approach. Multi-time frame approach. So let me show you this system here. I'll show you the last 10 years of backtesting, how to do that backtesting. First of all, whenever you're doing the backtesting, right, let me tell you what you should need to focus. First, ensure that you're having a proper data set over here. So this is a data set I've been having right from when exactly? Yeah, so almost Jan 1st onwards, I've been having this data. January 4th, 5th, 6th of 2011. This is from 2011 onwards. 11 to 2020, that is approximately 10 years of data I'm having over here. I'm going to pull up this Wheelintra V5 strategy. So it's under Trade Studio, Systems. Nifty 15. So I'm going to select the strategy like 15 minute. It's a 15-minute trading strategy. Same long and short, the initial equity is same, and the percentage is 0.02%. And I'm going to press OK. And current is what I'm going to select here. One other thing is that if any strategy you're doing over here, first thing is that you have to go and check what is the position sizing. So maybe different system might have different position sizing, or you can change your position sizing according to your requirements. You can choose based upon the value. You can select how many shares you want, fixed quantity of shares, or fixed number of values, or fixed quantity or fixed percentage on your trading capital. So all those things can be made. So in this case, I had set only as like one lot I'm going to purchase. And for that, only one lot, no matter what, no matter wherever Nifty is going to make, I'm going to simply use only one lot. That is a perfect way to test a trading strategy, right? Maybe that is not a reality because different people will adopt different trading style. But this is a perfect way to test only one lot. You go and purchase, what is going to happen. That will tell you about your risk involved in that particular trading strategy. Or you can also test using a fixed value also, fixed value or fixed lots. That is what primarily used to test a trading strategy. So let me click on the backtest button here. And you can go and check out the entire strategy. Just click of a button, right? The 15-minute trading strategy, the results has been done within a matter of, maybe I can pull you that results. So here are the results. Where it is. Oops. Just give me a second. Somehow it's not popping up. Yeah. So it had done 1,298 trades in the last 10 years. And the win rate is only 43.3%. Means 56% of the time strategy is going for a loss. But still strategy is profitable because of the risk reward ratio. You look at the average profit is like 7,400 rupees and the average loss is 4,200 rupees. So net, it is resulting in a profitable game. And so here are the equity curve over here. So this is the equity curve for the last 10 years and the drawdown equity curve. Yes, there are phases, there are strategies going for a drawdown period. You can see that these are the phases strategy went for a drawdown period. And then here are the phases strategy went for a drawdown period. Strategy went for a drawdown period. So various places, these are the painful places where you can see that the strategy goes for a frequent drawdowns. Even recently also there was a drawdown here, which got recovered because of this during the March season, there was a crash and then During that time, the strategy recovered all those drawdowns. There was a drawdown from October to, I think, December or January. And after January, there was a breakout and volatility started showing up and price started recovering their profits. So far, there are major drawdowns happened over here. So one, probably 2, 3, 4, 5, 6, 7 places, or even there are minor drawdowns happened over here. All these are small drawdowns. Very frequently, a strategy is going to go through a drawdown phase. Maybe if you're seeing an equity curve like this, right, you might get mesmerized. Whoa, what a equity curve. But still, let me tell you, this is not that easy going to be trade. Unless you're not going to prepare your mindset. Somewhere here or there, you're going to give up your belief in that trading system. This trading system has been designed somewhere around 2017 is what it had designed. And so far it is a 3-year-old trading system, by the way. Now, the thing is that, as I said, backtesting itself not enough. That is where you have to do the Monte Carlo kind of testing. So all those Monte Carlo testing, if it is passing, then only you can go and take your strategy live. Otherwise, there is no point of sitting and trading the trading system. If your strategy itself not passing Monte Carlo, but still your backtesting results are good, it is extraordinary results. There is no point of trading that strategy. Maybe it could be a curve fitted one. Maybe it is kind of an over-optimized strategy. So how to do that Monte Carlo? Again, it will be explained in the Quanzilla section. Now coming back to the topic here. So this wheel intra V5, right? It has a channel based approach. It's the interesting part is that it's an adaptive channel, and it's simply a breakout levels. Whenever you're seeing a red candle, the breakdown of that red candle automatically it goes for a breakout trading, and it will keep on maintaining its downtrend. It will try to look for an price to cross the upper channel. So you see that there are two channels over here. One is an upper channel, another one is a lower channel. So the green one is the upper channel here. This is the upper channel, and this is the lower channel. The red one is the lower channel here. The red one is the lower channel here. The channel itself built on top of a VWAP based. Remember, it's a VWAP based linear regression channel. Linear regression channel. It's a VWAP based linear regression channel, and it has both upper channel and lower channel. So it is like when the upper channel price is breaking, right? Let's say this is upper channel and this is lower channel. If the upper channel price is breaking, and let's say that level, when the price is coming and breaking again, that the touch of the point is where your actual trade. This is where the actual buy happens here. And similarly, when you're having the channel here, price, even if it is touching the lower channel, right? Even if the price is touching the lower channel, not necessarily it has to close down below that. Here in this case, price has to close above the upper channel, then only it qualifies for the buy signal. Whereas here, in case of a lower channel, even if the price is touching the lower channel, even slightly, even it is going down, that low is again getting broken. The touching point is where your sell signal is happening, because sell signal generally happens a bit quicker. So you have to try to enter a bit faster. That is what the trading strategy is trying to attempt to do here. So even that channel low, if it has been touched, the touch of the level is where your trade happens over here. And at the very same level is what will be displayed in the dashboard also. So it's a touch-based trading system. It is not an end of the candle trading system. Generally, many trading systems in the markets are end of the candle basis or end of the day basis trading systems. This is more of a level-based trading system. We call that as a touch-based trading system. Touch-based trading system. But still, what it does is that it doesn't predict anything in the market, just simply follow the trend. If the market bends, it doesn't care. You see that the market bends down, it immediately goes short. Market comes back again, it cuts down, and immediately again, it looks for a long opportunity again. So no matter whatever the economic conditions are, even if the markets are, even if the entire economy is going for a lockdown, you should go and follow. If you are getting a buy signal, you have to go and buy the signal here. Let's say when the demonetization is announced and still market open gap down, and after the gap down, price started going long, you should go long here. And that is what the most challenging thing is. Most people will selectively take trades. What people will try to do here is, again, this is a beginner level mistake. What people will do, they will try to buy here, probably. They will try to buy here. And tomorrow, there is a good news is there. They will think like, let me hold this position. Let me hold. Let me not go down. Let me not sell this. Let me not sell here. Let me hold this position. Probably at that time, they might get lucky. Next time they will try to do the same thing and market goes down. They will be thinking, oh my God, I'm making a mistake. I am not able to follow my own rule. I'm doing something mistake. They'll start blaming on the indicators. And that is what you should not do. If it is a buy, you have to buy. If it is a sell, you have to sell. There are no questions asked. That's how you can become a better systematic trader. All right. Anyways, so I guess we can take a couple of questions here before unwinding for the day. Otherwise, I guess I had taken an extended amount of your time. I hope you learned something new in this section. So the entire equity curve, backtesting statistics, everything will be uploaded and it will be shared in the YouTube video. So make sure if you want to go and revise, you can go and check out from the YouTube channel. So I'll take a couple of questions here before saying thank you to you people. So let me take questions here. And there is a small promo here. So what I want to show is like there is an one of the product that we are running here is Algo Mojo platform, especially for systematic traders who want to trade their own trading system. We are offering an free algo trading platform, totally an free API and free algo trading access will be provided whoever opening and trading account with Algo Mojo. So they will be enjoying free access to both API as well as the trading platform as well. So that will primarily reduce the overall cost of the algo traders. And so yeah, that is what we are mostly looking for, algo traders who can who wants algo trading facilities at one single place. Anyways, coming back to the topic here, let's take a couple of questions. So Vinod Morak is asking how to overcome emotions. Of course, you cannot. Emotions are always part of the game. You cannot avoid it, but only by doing in systematic trading you can reduce your emotions. You cannot overcome emotions. Emotions will be always there, but despite that, you have to be disciplined enough, and that is a hard part of the game also. And that is where momentum trading will be successful. So Deepak Kumar is asking, is there any prerequisite for Quanzilla like coding or any other thing? So prerequisite is like definitely most of the topics will be done on Amibroker. So I mean, entire 75 hours is totally a coding program, and all the 75 hours of coding content will be there. So generally, it will be designed. The basic strategies it is designed for non-coders, and the advanced strategies it is designed for advanced traders, right? So when I say advanced traders, without attending the basic, it is very difficult to move to the advanced. So basic, you will be getting the basic programming language, 75 to 85% of the content. You don't need any basic programming language prerequisite without programming language also, because everything we will be starting right from the scratch. And however, 15% of the content, there'll be slightly advanced programming will be there, but still there'll be step-by-step instruction so that even a non-coder can understand those complex programming languages. They can easily understand that. However, 85% of the content will be majority. Even non-coders can go and understand those kind of stuff. And other requirements are like some basic F&O knowledge or some basic technical indicator knowledge is necessary, because all of a sudden we'll be using an RSA function or MACD function, and you cannot come and say like, hey, I don't know what is MACD. Can you tell me what is MACD? So at least some basic technical knowledge, basic F&O trading knowledge, or basic some trading or investing knowledge is required. And yeah, we'll be focusing on both investing strategies as well as on trading strategies, how to build your own trading strategies, how to build your own scanners, or dashboard, alerts, everything will be starting right from the scratch. We will be taking it to the advanced level. That is where the 75 hours of coding effort, all those codings will be done live. And yes, very few codings here and there. We'll be talking about some existing strategies or existing ready-made stuff. We'll be talking about that. Otherwise, a lot of case studies will be discussed here. So the core objective is to make you as an independent trader so that you can build or design your own trading strategies. So is this only on Amibroker? Yes, of course. Currently, we are doing it in Amibroker, but later we will be extending it to TradingView and Python kind of platforms as well. Currently, it is done on Amibroker because that is where majority of the people will be able to learn its programming language and they can implement their own programming language. So are we covering technical training under Quanzilla or only coding? This is a question from Bhavin Mehta. So the thing is that we are going to cover only coding perspective. Yeah, a bit of technical training will be there, like some of my past experience on technical analysis that will be shared, but predominantly it will be only on coding perspective. And coding and how to efficiently design your trading system, how to efficiently design and test your trading system. What is the proper way to design? What is the proper way to test? That is what will be taught in the Quanzilla. And of course, we are doing three more preview webinars. I guess 2 or 3 preview webinars we'll be doing up. Next week, probably we will be talking about how to automate your own momentum trading strategies. That is what we're going to discuss in the next week. It's all about automating your trades. So if you are very much interested, you can come back and join next week. You can always go to quanzilla.in and there you can go and register yourself. What is the time frame to be followed in Lintra trading system? So this is a question from Sundar Rajan. Right? So if you are trading Lintra has various variants, right? So there is you go and install Trade Studio. It comes with various variants. If you're using Lintra V3, you can go and deploy it in a kind of it's an pure intraday trading system. V3 and V4 are pure intraday trading system, predominantly for high beta stocks and Bank Nifty. K-Lintra V5 is on hourly. In fact, sometime back, I also done an article on the performance of K-Lintra. So K-Lintra, you can just Google about Harley trading system, right? So you'll be able to get that particular article. This is for Nifty futures, basically. So you can see the complete backtesting reports, the complete trading capital, how much of trading capital is deployed, what kind of leverages has been taken. Right? So you'll be able to see the complete backtesting report on that. And year-on-year profits, what so far it had delivered. Everything you'll be able to figure out from here. And the other thing is like, that is mostly on hourly, whereas Lintra V5 we have 2 variants. One is for Nifty, another one is for Bank Nifty. Nifty it is on 15-minute and Bank Nifty it is on 5-minute, because you know that Nifty moves very, very slow. So compared to 5-minute, 15-minute is even more efficient. 5-minute is good, but 15-minute is super good. And Bank Nifty, it moves really faster. So you need to go with a lower time frame. So Bank Nifty 5-minute is something which is really an interesting one. So let me also show you the backtest results of that as well. So let me send it to analysis. I'll edit it. I'll send it to analysis. So it comes to analysis here. Bring it to Bank Nifty. Bank Nifty. Look at the position sizing code. Obviously, the position sizing code looks for only one round lot size. So go back and check the round lot size here. So go to the symbol and instruments. Interpretation. Information here, round lot size has been changed to 25 and margin deposit is minus 25. That means 4 times of leverage. 4 times of leverage we are taking. Now exchange also increased that leverage. So obviously we cannot take an extended leverage here. And the strategy itself we have to apply on a 5-minute time frame and press backtest here. Right, so you'll be able to get an returns. Obviously you have to deploy additional capital here because it is a Bank Nifty. And Bank Nifty is now like 24,000. Earlier it was like 12,000, 18,000. Now the Bank Nifty value is also increasing. When the value increases, margin also increases. So obviously you have to deploy substantial margin also here. And the equity curve goes like this. This is last 10 years of backtesting report. There has been a deep drawdown which was there, right? Almost the drawdown went on for almost 6-7 months and then it recovered back. I think after February is what the most of the recovery happened. March, April, May is where most of the recovery happened here. So let me take. So can you open the chart of intellect? I think laggards are entering now. How to confirm this? Probably the only thing is that you cannot confirm. There are various ways to confirm it. There are tools like market profile kind of tools that will guide you to confirm it. So let's say intellect, right? I don't know. So probably what I can tell you is that better you have a process. So let's say intellect. I don't know whether it is trading. Yeah, intellect design arena. Probably it looks like an small cap stock to me. Yeah, it is a small cap stocks. I don't know. I don't know whether what is happening. So I don't give any inputs on these kind of stocks. I don't even look into these stocks, right? So because I think long back once I traded in penny stock back in 2008. I think one of the stock name called Sabera Organics. By that time it was like 20, and very quickly it went to 25. So I mean, that is the last time I just traded penny stocks. Otherwise, I'm not a very good penny stock player, and I stopped trading pennies. I stopped investing in penny stocks after 2008, and until then, I moved primarily to rule-based trading. Mostly on my trading is predominantly on Nifty Bank Nifty futures, um, and these days on stock futures as well, stock futures and currency futures and options. I mean, I'm not an expert in small cap, or I'll be looking into that. I know what is happening at the small cap level or mid cap levels, or at the sector level, what is happening. I am aware about that, but I'm not an expert in what is happening at that penny stock level, whether it is a laggard or not. I don't know about the inner thing of the what is happening inside the small cap. I know what is happening at a small cap level, but I don't know what is happening at an individual stock level. I'm not the right guy to comment on that. I was tracking, I think up to 2010, I was tracking each and every stock, each and every penny stock, mid cap stocks, all those things I was tracking. But once I moved to rule based investing, I started focusing only on selected counters, like high volume counters like Reliance or HDFC Bank, ICICI Bank. So those are the counters I've been, I shifted myself to that kind of mode. So I don't track, I don't know what are the stocks which are there in the small cap segments. I don't know what are the stocks which are there even in the mid cap segments also. So will automation will be covered as the part of the Quanzilla basic? Yeah, automation will be covered, but some of the complex execution modules will be covered in the Quanzilla advanced part. The basics of Algomojo or the basics of automated trading or various tools available for automated trading, all those things, cost involved, everything will be discussed. And at the coding level also it will be discussed in the basics section. However, more advanced execution modules will be discussed in the advanced part only. Like some of the thing like option backtesting, where multi-legged option backtesting, those are slightly complex modules to build in when it comes to option trading. There, it will be discussed only in the advanced part. So Algo Mojo for fires. Of course, right now we were also currently we had integrated with the brokers like um, Alice Blue, TradeGenie, and Zebu. We are also in talks. I mean, already we've been implementing for fires and upstocks. So probably fires and upstocks are the next upcoming brokers who are likely to onboard. And also we are also integrating Symphony FinTech APIs. So if somebody is having a Symphony FinTech associated brokers, they also, I mean, I think some 20 brokers are associated with them. I guess 15 to 25 brokers are associated with them. That also sooner or very sooner, probably before the end of this November, we are expecting to go live with upstocks, with fires, and with Symphony FinTech APIs as well. And that's a question from Vimal. So Krishnamurti is asking, is there any method to run market profile in Ninja without paid data? Of course, without paid data, right? You can take the data from your own Nest trading terminal or something like that, but the quality of the data, right, it is not guaranteed. And moreover, whenever you are running tools like market profile or order flow, the quality of the data is very, very important. So better invest in some tools. That's what I can say that. So Kumar is asking a question. Algo trading in Algo Mojo is for index or stock trading? What is the minimum investment required for algo trading? See, algo trading, right? There is no minimum investment as such is required. So it's up to you, like what you want to do, like what do you want to automate, basically. In that particular strategy, you have to come up with your own strategy. If you are having a strategy and you want to automate it, right? So how much you would like to invest? That is a question you have to ask yourself. Probably if you're an option, I mean, let's say it's a stock intraday trading strategy, even with 10,000 also you can run as automated trading strategy. Or if you want to run a strategy on top of futures, definitely your strategy definitely required a minimum of 2.5 lakhs for every one lot. Or if you are running a portfolio of strategy, like let's say like on a 50 symbols, all the 50 symbols you are running your own particular strategy you are running. In that case, obviously you need, I mean, it depends upon how much you're going to invest per symbol or what kind of risk approach you're going to take, what is your drawdown. So depends upon that, your capital can be decided. It can vary from 2 lakhs also, it can go to 50 lakhs also. So it differs in every case. So we cannot put a formula to that. So how much is the basic minimum investment required? It depends upon the strategy, right? Let's say if you're running a strategy on something like USD-INR, hardly USD-INR, it requires hardly per lot how much? The margin is very less, right? Less than 2,000 rupees or something. So even with 2,000 rupees also you can do, and you can take one lot features in USD-INR. So that's not a big deal. Which instrument you want to trade, how confident on that trading system, so that how much you can, you're willing to park your money, how much you're willing to risk. That is a question you have to ask yourself. That will happen only if you start doing the back testing and you start following the risk metrics. So that is where you can design your own risk management. And you can, okay, probably this is the right size to allocate money. If you're very new to algo trading, I would say that you should start something small, try to get a hang of algorithmic trading, and then you can start parking your money. Once you're getting confident about the process involved in algorithmic trading, then only you can go and take bigger bets. Then only you can increase your size. Let the confident, let it get built. Let you make some money on algorithmic trading. And money should be made first to gain confidence. Then only you can go and park bigger money. So like to know on PineScript training, right? So will it be same good for automated trading like Amibroker? I would say that Amibroker is super advanced because you can even build algorithmic trading strategies which are two-way, whereas TradingView is still super intelligent, low cost, and execution is also good, but it is more of a one-way communication. You cannot build complex execution strategies in TradingView. However, anything, even simple indicators or complex indicators, it can be built on TradingView, but only simple execution strategies are possible in TradingView. Complex execution strategies, let's say you want to buy an option, you want to do an complex option strategies, multi-legged strategies, and you want to monitor and you want to do adjustments, or you want to scale in, scale out. So those kind of advanced level thing, it is difficult to practice. Or if you want to, let's say you want to trade a 50 symbol portfolio, that is very difficult to do with TradingView, because TradingView at any given time you can open a maximum of 4 charts or 8 charts, I guess. Beyond that, it's very difficult. So if you are running a portfolio of symbols, then you should go for Amibroker. Or let's say you're going to trade only Nifty futures, or only Bank Nifty futures, or only crude oil. If it is a chart based, maximum 1 or 2 charts, yes, you can run an algo on TradingView. But however, TradingView has a serious limitation when it comes to portfolio trading, or when it comes to, let's say you want to design a trading system, something like a cross-sectional momentum strategies. There, a lot of serious limitations are there. You cannot build an portfolio level trading strategies in TradingView. I guess mostly at this point of time, You cannot do most of the backtesting which are available in TradingView are single script. You cannot build a portfolio level trading strategies there in TradingView. That is again one limitation as of now they are having. But Amibroker doesn't have such kind of limitations. So that is what it difference between Amibroker and TradingView. So is it possible to send orders from Excel in AlgoMojo? Yes, it is possible. I think you can check with the team. They're already having an ready-made module where you can send orders from Excel. That is, yes, that is possible. Or if you're good enough in VBA, you can write your own VBA script and you can send orders from Excel. From Excel, you can send from Amibroker, you can send from Ninja Trader or whatnot, from MT4, MT5. It can be any trading terminal as long as it is supporting APIs. You can send orders. Even Python also, you can send Python or Java. It doesn't matter. You can send orders via any customized programming language also. So what is the charge for using algo trading per month? So there's a question from Krishna Murthy. Let me tell you, the charges for algorithmic trading is like right now. I'm sorry. There is I explained in one of the article here, and probably you can go to AlgoMojo. It's explained there itself. If you go to algomojo.com, there is an blog is available there. So enter the blog, you can get to know about what is AlgoMojo API, what is the cost involved with that. So here is the list of cost I had explained. Generally, there will be an API cost will be there. That will be free. An AlgoMojo platform fee will be there. That will be free again. Data feed, if in case we want, you have to arrange data feed externally also. You can arrange internally also. If you are arranging internally, we are supporting two vendors, both are authorized data vendors from NSE. Global Data Feeds and True Data is what we are supporting at this point of time. Data is also data API. If in case if you are using tools like Python or Java, then there will be a data. You need to subscribe for some sort of data API cost, and that is also optional. And again, we are supporting both Global Data Feeds and True Data for the API solutions. Strategy, again, you will be able to find in free libraries as well as Trade Studio kind of packages. And platforms, currently we are supporting Amibroker, MetaTrader 4, 5, TradingView, Excel, C#, Python, or any platform that support REST APIs. And in case if you want VPS servers, virtual servers, or you want to run servers in the cloud, that is also optional. So basically, there is no commitments required, no limited things. You can go under any brokerage plan. There is no restriction there in doing algorithmic trading. So what the major two components has been reduced here. Absolutely no API cost, no platform cost will be assumed, no bridge cost, nothing will be there. And yes, there are no commitments for that. There is a minimum turnover you have to do that. There is no such commitments there. Absolutely no commitments. All right. If you're happy, you can continue your trading, and if you're not happy, anytime you can move ahead. That is also there. So this is for the AlgoMojo clients. For non-clients, there will be a API cost will be still free, but AlgoMojo platform fee will be there if you are not an AlgoMojo member. Right? Yeah, that is the cost associated with AlgoMojo. I mean, a lot of detailed blog is there. Frequently, we've been doing a lot of training articles also, how you can write your own execution modules. Some of the simple execution modules and complex execution modules will be posted here time to time, and you can make use of those things if you're an Amibroker user. So it will be explained with videos, how you can send orders from scanners, or how you can send orders from, how you can send the smart order execution features. That is what it is explained here. How to build this smart order execution is what will be taught in the Quantzilla kind of programs. All right, so I guess a lot of things has been discussed here. Let me do one thing. Let me say thank you, and hope you learned something new about momentum trading. Thank you once again.